Are you a beginner who is new to trading and you find it difficult to read the chart patterns or are confused about the pattern for the trade? Sweat no further because we'll discuss the different chart patterns a trader should know in this video. Make sure you stick around until the end too because this guide might be just what you have been looking for. A chart pattern is a shape within a price chart that can help predict what prices will do next based on previous behavior. Technical analysis is based on chart patterns, which require traders to know exactly what they're looking at and what they're searching for. It's also considered the market's behavior according to the market's movement with the price. But because they all are utilized to indicate diverse trends in a wide range of markets, there's no such thing as a quote-unquote great chart pattern. Chart patterns are frequently used in candlestick trading, making it more straightforward to see prior market openings and closes. But before we get into the nitty-gritty of different chart patterns, it's vital first to understand what support and resistance levels are. The level at which an asset's price stops declining and begins to rise is referred to as support. Resistance is when the price stops, typically increasing and begins to fall. For traders, chart patterns are important parts of technical analysis, but they take some time to practice to master before you can utilize them effectively. Here are 10 chart patterns that every trader should be aware of. Number 1. Head and shoulders. This is a chart pattern showing a huge peak on one side and a somewhat smaller peak on the other, is known as a head and shoulders pattern. Traders use head and shoulders patterns to indicate a bullish to bearish reversal. The first and third peaks are usually smaller than the second, but they all return to the same degree of support, often known as the neckline. It is expected that the third peak will break down into a bearish downtrend once it has fallen back to the level of support. Number 2. Cup and handle pattern. This pattern is referred to as the cup and handle pattern because it is a cup-like structure where we have the preceding uptrend, the cup-like structure in the middle, and the handle at the end. The cup and handle pattern is a bullish continuation pattern that depicts a period of bearish market sentiment before the overall trend returns to bullish territory. Looking at the trading chart, it does not mean the cup area forms a perfect curve, so we have to be flexible in trading. Following the rounding bottom, an asset's price will most likely begin a short retracement called the handle, since it is limited to 2 parallel lines on the price graph. The asset will finally break free of the handle and resume its bullish trajectory. Number 3. Double top. Another pattern that traders use to show trend reversals is a double top. It forms 2 peaks in resistance. Typically, an asset will reach a high point before retracing to a level of support. It will rise once more before turning back against the current trend. So you need to take your entry as soon as you can see an accurate breakdown. Number 4. Double bottom. A double bottom chart pattern suggests a period of selling with the price of an asset dropping below a support level. Then it will rise to the point of resistance before descending. Finally, when the market grows more positive, the trend will invert and begin to go upward. A bullish reversal pattern is a double bottom, which indicates the conclusion of a downward and the beginning of an upswing. Number 5. Rounding bottom. A rounded bottom chart pattern might indicate a reversal or continuation. If an asset's price was in a downward trend and a rounding bottom formed before the trend reversed, that would be an example of a bullish reversal. Traders will attempt to profit from this pattern by purchasing halfway around the bottom at the low point and profiting from the continuation after breaking over a resistance line. Before moving ahead, make sure to leave a like and don't forget to join our community by hitting that subscribe button. If we missed something important so far, let us know in the comments below. Number 6. Wedges. When the price movements of an asset tighten up between 2 sloping trend lines, wedges occur. The 2 forms of wedges are rising and falling wedges. A rising wedge is a trend line that is trapped between 2 upwardly sloping lines of support and resistance. When an asset's price breaks through the support level, this pattern usually indicates that it will eventually permanently decrease. Between 2 downwardly sloping levels, there is a falling wedge. The resistance line is steeper than the support line. Rising and falling wedges are both reversal patterns, with increasing wedges typically indicating a bearish market and falling wedges meaning a bullish market. Number 7. Pennants or flags. After an asset has had a period of upward movement followed by a stabilization time, pennant patterns or flags are formed. There will usually be a considerable gain during the early phases of a trend before it breaks down into a succession of minor upward and downward movements. Pennants can either be bullish or bearish, indicating a trend's continuation or reversal. While a pennant may appear to be similar to a wedge or triangle design, it is vital to remember that wedges are narrower than pennants or triangles. Wedges and pennants are distinguished by the fact that a wedge is either rising or descending, but a pennant is always horizontal. Number 8. Ascending triangle. The ascending triangle is a bullish continuation pattern that indicates that an upward will continue. Place a horizontal line along with the swing highs, the resistance, and then draw an ascending trend line along the support to create ascending triangles on charts. Ascending triangles frequently feature two or more identical peak highs, allowing for the drawing of a horizontal line. The trend line represents the pattern's overall uptrend, while the horizontal line represents the asset's historical resistance level. So, as a trader, it is advisable to make an entry as soon as there is a proper breakout. Number 9. Descending triangle. The opposite of the ascending triangle is the descending triangle. A descending triangle is a downtrend that indicates a bearish continuation of a decline. A trader will typically enter a short position to profit from a dropping market during a descending triangle. Because descending triangles suggest a market driven by sellers, lower peaks are likely to be prevalent and hard to reverse. They tend to migrate lower and break through the support. A horizontal line of support and a downward sloping resistance line distinguish descending triangles. The trend will eventually break through the support and the downturn will resume. Number 10. Symmetrical triangle. This is the third type of triangle. The symmetrical triangle formation can be bullish or bearish, depending on the market. In either instance, it's usually a continuation pattern, which indicates that once the pattern is created, the market will usually continue in the same direction as the primary trend. So on the chart, we can see the descending upper trend line and the ascending lower trend line, and this triangle can face any direction, be it upward or downward. So traders need to be careful while placing a trade in this pattern because it may give out a free breakout. So now that we know the 10 trading patterns, which of these patterns have you used recently? Let us know your experience in the comments below. Make sure to subscribe to the channel, leave a thumbs up, and hit that notification bell, and we'll see you in the next video.